Crude oil has started the new week on a positive note. It's expected to rise and consolidate above $90 per barrel. Moreover, the bull run is likely to continue. Growing concerns of tight supplies amid rising fuel demand are named as the driving force for oil. The global economy is recovering at a faster than expected pace. Meanwhile, major oil producers continue their policy of limited output. Against this backdrop, the assets will definitely continue its bullish run. Nevertheless, there are certain limiting factors. Thus, oil has just broken the psychological level, and the market needs some time to prepare for further growth. In addition, investors are now awaiting Saudi Arabia's and Russia's statements. Both oil producers have repeatedly emphasized they are not interested in a sharp increase in oil prices. If no announcements from Moscow and Riyadh follow, the bullish trend will resume. In terms of short-term technical analysis, Brent crude futures show growth today, following a brief pullback and a sideways move. Hype and speculation are driving the price of the instrument further up, and the quote has updated its swing high. Taking into account the current speculative sentiment, the price may consolidate above $90 per barrel. If so, the psychological level of $100 per barrel will stand as a target. Speaking of forex trading, the Russian ruble is retracing up. Russia-Ukraine tensions are gradually easing, and all further statements about the conflict are becoming less acute, no longer causing turbulence in the market. In this light, investors are guided by the technical picture. Being excessively oversold, the Russian ruble is heading towards the level of 76. Under the current circumstances, the Russian currency may soon recover to this mark, as it is too early to talk about a stronger ruble or a bullish trend. Technically, the dollar versus the ruble pair is still retracing up, following a pullback from the level of 80. The Russian ruble has already recovered by 3.5%, but remains in the oversold zone. If the quote settles below 77.20, the level of 76 will stand as the target. Alternatively, the price may trade sideways in the range between 77.30 and 78.50. Meanwhile, gold keeps incurring losses, which confirms the fact that investors no longer perceive it as a hedge asset. There has been increasing speculation over the possibility of a rate hike by the Bank of England on February 3rd. Moreover, the US Federal Reserve is expected to raise the interest rate in March. These are the two major factors contributing to a fall in the price of gold. Such a rapid and substantial decrease may trigger a technical correction soon. The dependence of the precious metal on the decisions of the central banks confirms the assumption that the bear run will continue. In addition, if the ECB makes a statement about monetary policy tightening, gold will possibly tumble to $1,775. So far, the technical picture is the following. Gold went down and closed at $1,779 last Friday. Overall, the precious metal has lost 4% since the FOMC meeting, which is a considerable drop given such a short period of time. Therefore, traders now see the oversold status of gold as the likelihood of a technical correction or a rebound. This has been the Monday forecast. As you can see, general sentiment contributes to the active movement of trading instruments, and we hope that you will be able to accurately determine where prices will go next. Have a nice trading week. Bye.